A condo purchased for $240,000 resold for under $125,000. Less than 3 years later, no flood damage, no structural failure, no code violations, just a livable unit that handed its owner a 48% loss. That is not an outlier, Aid. That is the Florida market in 2026. Home values across Florida have dropped significantly over the past year, while nearly every other state in the country moved in the opposite direction. Foreclosures are now higher in Florida than anywhere else in America, one filing for every 230 homes. The national rate is 1 in 385. That means Florida is running at nearly double the pace of the rest of the country. And a major risk report released just 4 days ago identified 16 of the 50 most at-risk counties in the entire United States as being located in Florida. Charlotte County, Punta Gorda, came in at number 1 on that list. This is not a correction. This is a cycle, and understanding exactly how it works is what separates the people making smart decisions right now from the ones who will regret them later. The foreclosure data has gotten dramatically worse. Start with the numbers because they are severe. Adam Data Solutions published their year-end 2025 report in January, and Florida claimed the worst foreclosure rate of any state in the nation. 1 in every 230 homes received a foreclosure filing compared to the national figure of 1 in 385, and the trajectory is not improving. Through February 2026, Florida has recorded 12 consecutive months of year-over-year foreclosure increases. December alone was particularly brutal. Filings jumped 57% in a single month. Bank repossessions climbed 35% over the prior year. A U.S. economics professor noted in November that consecutive monthly foreclosure increases of that length are highly unusual. A pattern not seen since 2008. That comment was made at 8 months in a row. The current count is 12. Zoom into individual metros and it gets sharper. Lakeland and Polk County now hold the highest foreclosure rate of any major metropolitan area in the entire United States. 1 filing for every 145 homes. Cape Coral ranks 4th nationally. Jacksonville is 6th. Tampa carries the worst rate of any metro with a population over 1 million. The Adam Risk Report mentioned earlier reinforces this at the county level. Charlotte County earned the top ranking based on a combination of foreclosure activity, underwater mortgages, housing affordability, and local unemployment. And that underwater mortgage data deserves its own attention. Cape Coral currently leads every market in the country, with 7.8% of homeowners owing more than their properties are worth. Nearly 1 in 12 homeowners in that market is underwater. That is the exact condition that fuels the next round of distressed sales and feeds the cycle forward. The condo market is where phase 2 gets ugly. Most people outside Florida have not fully absorbed what is happening in the condo sector. This is not just a story about individual sellers taking losses. It goes much deeper than that. After the Surfside collapse in 2021, which killed 98 people, Florida enacted legislation requiring all condo buildings 3 stories or taller to complete structural inspections and fully fund their reserve accounts. The reserve funding deadline landed on January 1st of this year. The bills are now arriving. The scope of this is significant. Roughly 900,000 condo units in buildings over 30 years old fall under these requirements. Already, 40% of Florida condo owners have been hit with a special assessment in the past 3 years. These are not minor fees. Cricket Club in North Miami issued a $134,000 per unit assessment for roof and facade repairs. One owner there had liquidated retirement savings to purchase a unit for $190,000, was then hit with that assessment, and ultimately sold for $110,000, a 42% loss. Mediterranean Village in Aventura is charging assessments of up to $400,000 per unit. A 79-year-old woman in another building received a $224,000 assessment on top of monthly dues that had already doubled to $3,000. For retirees on fixed incomes who bought condos assuming their housing costs were locked in, these bills are financially catastrophic. The situation is compounded by what Fannie Mae has done in response. Over 1,400 condo buildings in Florida have now been placed on a restricted list, meaning no conventional mortgage financing is available for units inside those buildings. A buyer either pays all cash or does not buy at all. For anyone trying to sell inside one of those buildings, the eligible buyer pool has effectively evaporated. The data reflects all of it. Statewide, condo prices declined 4.7% last year, while single-family homes fell only 1.4%. Condos are declining at 3 times the rate. Miami-Dade is carrying 13.2 months of condo supply. Active condo listings surged 37% in a single year. 70% of condos are selling below asking price. Average monthly HOA fees for high-rise buildings in Miami have now crossed $1,900, up $500 from 2024. And in January, an entire condo association, Palm Greens at Villa Del Rey in Delray Beach, filed for Chapter 11 bankruptcy, carrying $43.7 million in liabilities. That is not a homeowner going underwater. That is a full Badinley residential community entering insolvency. When condo associations begin filing for bankruptcy, the nature of the downturn has shifted. That is what phase 2 looks like. Demand has collapsed alongside supply. The supply side is flooded. Foreclosures, forced condo sales, and distressed listings competing against each other. But the demand side has deteriorated just as severely. The Census Bureau confirmed that net domestic migration into Florida fell from 310,000 people in 2022 to just 22,500 in 2025. That is a 93% collapse. Florida dropped from the number 1 destination in the country to number 8. The state is now receiving fewer domestic movers than Alabama. Let that land for a moment. Alabama is attracting more Americans than Florida right now. United Van Lines, one of the largest moving companies in the country, now classifies Florida as a balanced market. 52% inbound, 48% outbound. During the pandemic years, Florida was among the most lopsided inbound migration states in the country. That distinction is completely gone. The reasons people are leaving mirror the reasons the housing market is under pressure. Insurance is the primary driver. Florida homeowners pay an average of $7,136 per year for coverage on a $300,000 home. The national average is $2,543. Florida's rate is 181% higher. In Miami, average annual homeowners insurance exceeds $22,000. When you stack property taxes, flood insurance, and HOA fees on top of that, a typical $400,000 Florida home carries between $11,000 and $22,000 in non-mortgage carrying costs every single year before a single mortgage payment is made. Climate risk has also fundamentally shifted buyer psychology. 6 hurricanes struck between 2022 and 2024, 4 of them category 3 or higher. Redfin surveys now show climate concern as the number 1 reason Florida residents say they are likely to leave the state. Tampa tells the story in a single data point. Net inflow dropped from 35,000 to 10,000 in 1 year, the steepest single-year slowdown of any of the 50 largest metros in the country. The labor market is adding fuel to the fire. Behind the housing data sits a weakening economy. Florida's unemployment rate hit 4.3% in December, up nearly a full percentage point year over year and among the steepest increases of any state. Initial jobless claims surged more than 33%, while the national figure actually declined during the same period. WARN Act layoff notices reached 234 in 2025, affecting more than 26,000 workers. the highest total since 2009. Kroger shuttered fulfillment centers in Tampa, Groveland, and Jacksonville, eliminating 1,400 positions. Frito-Lay closed 2 Orlando manufacturing plants. Disney has reduced its workforce by over 8,000 positions since 2023. Tourism arrivals fell nearly 9% in the first 9 months of 2025. Construction employment is contracting. Florida's unemployment safety net pays a maximum of $275 per week for only 12 weeks, among the lowest benefit levels and shortest durations of any state in the country. When jobs are lost in a market where mortgage payments are already stretched thin, missed payments follow. Missed payments become foreclosures. That is how the cycle feeds itself. Property tax relief on the table, not in hand. There is one potential development worth tracking. The Florida House passed HJR 203 in February by a vote of 80 to 30, a bill that would phase out non-school property taxes for homesteaded owners over a 10-year period. The House Speaker described it as among the most aggressive property tax legislation ever passed by any legislative chamber in the country. However, the Senate never scheduled a hearing before the regular session closed on March 13th. A special session is expected in mid-April, where the Senate is expected to introduce a scaled-back version. Even if legislation passes, it still requires 60% voter approval on the November ballot. And the fiscal math is significant. Full elimination would remove $18.3 billion annually from local government budgets. This is not a done deal. Even if it clears every hurdle, it would provide relief only to homesteaded owners, not investors, and nothing for condo owners already being crushed by special assessments. For anyone making a real estate decision right now, this cannot be factored into the math. It is months away from resolution at minimum. 3 data points that tell you how far prices fall from here. At US Realty Pulse, these are the 3 metrics being tracked to gauge where this market is headed. First, inventory. Florida hit 182,589 active listings in April 2025, above pre-pandemic levels. January 20 and 26 set a record for new listings for any January going back to 2008. Collier County, which covers Naples, is carrying unsold inventory that sits 200% above 2019 levels. Elevated inventory creates continuous downward pressure on price. That is basic supply and demand. Second, sales volume and deal cancellations. Condo sales declined nearly 6% last year. Dollar volume dropped over 10% after adjusting for inflation. But the cancellation numbers stand out sharply. In Orlando, 19.4% of contracts are falling through before closing. Tampa is at 19.1%. Miami at 18.9%. The national average is 14.6%. When nearly 1 in 5 transactions collapses, it signals buyers finding problems at inspection, walking after receiving insurance quotes, or simply deciding the market has more room to fall. Investor purchases in Orlando dropped 16% year over year, the largest investor pullback of any major metro in the country. Smart money is stepping back. Third, days on market and pricing behavior. The statewide median is 84 days. The national median is around 50. More than a third of all active Florida listings have price reductions. And in Southwest Florida, that figure exceeds 40%. The average sale to list ratio has dropped to a 96.2%, meaning sellers are consistently accepting roughly 4% below asking price just to close. When homes sit longer, prices move lower. All 3 metrics are pointing in the same direction simultaneously. What this means. Depending on where you stand for sellers, the market you are pricing against is today's market, not where values were 2 years ago. Price aggressively relative to your actual competition or plan to sit. For buyers, the leverage available right now is something Florida has not seen in over a decade. You have time, you have options, and sellers know it. This is not 2008. Lending standards are tighter, Equity levels in the broader system are higher. Cash buyers remain active, particularly at the luxury end. But the broad middle of the Florida market, and the $300,000 to $500,000 range where most transactions happen, and is in an active repricing. And based on the inventory, the migration data, the foreclosure trajectory, and the condo crisis, that repricing has more distance to cover. Long term, this correction may actually restore something important. Before the pandemic, someone earning $50,000 to $60,000 a year could realistically buy a home in Florida. That window closed hard. The market is moving back toward it, but it's not there yet. If this breakdown gave you a clearer picture of what is actually happening in Florida, make sure you are subscribed and have notifications turned on at US Realty Pulse. This data moves fast. A week-old housing report in this environment is already outdated. New numbers drop every week here, and the people catching them early are the ones making the smartest moves. Don't let the algorithm decide when you see this. Hit that bell and get it the moment it goes live. See you in the next one.